First of all, I would make sure that whatever structure you choose, the cost of administering it isn't going to outweigh the tax benefits of being in it.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network CREPN Radio, episode number 105. This is the podcast where we focus on investing in commercial real estate. We do this through weekly conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Thanks for joining us. My name is J. Darren Gross. Today, my guest is Patrick Camuso. Patrick is a returning guest. He's a CPA focused on working with real estate professionals nationwide. And today we focus on the importance of entity selection, why to not invest as a sole proprietor. And we also answer look at the questions you need to answer to determine, should I create an LLC or should I create an S Corp? All this and more. But first, a couple of quick things. If you are on social media, reach out and let's connect. I'm on LinkedIn, Facebook, Instagram, Twitter, and Snapchat. You can look me up. It's the letter J, Darren Gross. That's J, Darren, D-A-R-R-I-N, Gross, G-R-O-S-S. When you do, please let me know that you listen to the show. And otherwise, sometimes I don't readily recognize who's trying to connect with me. Also, remember here that our goal at CREPN Radio is to learn and share. So if you like what we're doing, here are two things you can do to help the show. One, if you know somebody who might like the show, use the share button and share the show. And two, please consider subscribing to the show. You can do this through either iTunes or Stitcher, and when you do so, please leave a review. Lastly, if you're on LinkedIn, be sure to check out our group, Commercial Real Estate Pro Network. It's a great place to network with commercial real estate professionals. All right, let's get on to the show. On the line this morning, I'm fortunate to have my guest. His name is Patrick Camuso. He's with Patrick Camuso, CPA. He's the principal there. He's based in Charlotte, North Carolina. His focus is working with real estate professionals in his practice. And in his spare time, you can find him whitewater rafting there in Charlotte, North Carolina. Patrick, welcome back to the program.
Thanks a lot, Darren. I appreciate it. Happy to be here.
Yeah, and I failed to mention before that you were on a prior episode. I think there we spoke about the different levels of investor kind of thing. I have to go back and check that to be sure.
We were a real estate professional status.
Right. That was a great talk there. So because of that, Patrick and I agreed to do a second episode and invited Patrick back to talk about today's topic. But before we get into the topic, Patrick, for the listeners, if you could give us a little bit more about you and your background and your practice.
Absolutely, and thanks again, Darren. I'm the founder of Camuso CPA. Like you mentioned, we're located in Charlotte, North Carolina. We're a full-service shop that's heavily focused on working with real estate investors and professionals of all types. About 80% of our clients are involved in the real estate industry at all levels, from very advanced to mid-tier to just starting out. We've really tailored our services and approach to the market to the real estate industry.
Okay. So today we were going to talk a little bit about entity selection. And for investors, it's definitely there are some considerations, questions to answer, and reasons to choose one or the other. So before we jump in, or maybe is there a best way to what's the best way to jump into this topic, Patrick?
I think the best way to look at it would be from the perspective of if I was possibly sitting down with a new client that's considering structuring a portfolio. Maybe they're starting out in real estate. we could go through the process of what that would look like, sort of what my preliminary questions are, and what are the decision levers that are going to dictate what type of entity structure that I would recommend to a client.
All right. Well, let's act as if I'm a prospective client and looking to get into real estate.
Absolutely. So, the biggest thing that I'm trying to figure out is whether or not this business is going to be an active business or a passive business, because that's going to have a lot of implications from a tax perspective, and you'll see why in a second. So really, when I sit down with a client, the first thing I'm going to do is get an idea of what their investment strategy is and what exactly that they're trying to do with their portfolio. If they are going to be buy and holders, it's fairly less complicated. You're really looking to just stick with a pass-through entity. It's either going to be a single member LLC or it's going to be a partnership. When I sit down with investors that are looking towards more active businesses, that's when we get into possibly structuring them in an S corporation. And the reason for that is because when you are considered an active real estate investor, you're exposed to self-employment tax. So you're exposed to a higher level of taxation. And as we mentioned in the previous episode on real estate professional status, forming an S corporation is one tax advantaged way to minimize the amount of taxes that you'll have to pay for self-employment.
Gotcha. So the distinction between the LLC and the S corp then is a lot of the taxing as far as your responsibility with withholding taxes, passive versus active. Is that what I gather?
Yeah, so the reason that you just want to be in a pass-through structure for buy and hold is because you're just going to pay long-term or short-term capital gain rates when you sell the property, and you're just going to pay income tax on your rental income. Now, if you're in an active business, you're also going to be exposed to self-employment tax. So the reason that you would want to form an S corporation is because if you do go into this structure, you're able to recharacterize a portion of your income as a distribution as opposed to a wage, which allows you to actually avoid paying self-employment tax on a large portion of your income. Now, the caveat to this is to do this, it's going to cost you extra money in the form of additional compliance costs. So you're going to have to file an S corporation tax return, which is going to cost significantly more because it's more time intensive and complex to prepare. Since you're setting your own salary, you're also going to have to work with a CPA to develop a reasonable compensation study to substantiate the level of wage that you pay yourself. So that's going to cost money. And then obviously, you're going to have to work with a CPA firm as well for the tax planning of an S corporation. So there are additional costs to forming an S corporation. And, all too often we do see clients come to us at Camuso CPA that get oversold on the tax benefits of an S corporation and are not fully aware of the additional costs that are imposed on them when they move into this structure, and sometimes they have an unfortunate surprise around tax time.
Gotcha.
So, sorry about that. I had my phone going off in the background there.
That's all right. So can an LLC not provide the active abilities? I mean, if you're an active investor, is an LLC not an option?
Well, actually, that's a fantastic question. And so, back to the example, if we're working with a client that's starting out and they mention that they are going to be engaging in active forms of real estate investing, many times what you'll see is they go into an S corporation right away. But then maybe, your first or second year into real estate investing, you don't have the level of success that you could expect. And the S corporation additional cost end up not outweighing the tax benefits of the corporation. So what I recommend to clients that are starting out in active businesses is actually to form an LLC. And then what that enables you to do is have a little flexibility in terms of your tax treatment with the IRS. You can maintain the LLC throughout the whole year, get the pass-through treatment. Obviously, then you're going to be exposed to self-employment tax, but you're not going to have the additional compliance costs. And then anytime throughout the year, you actually can make a retroactive S corporation election with the IRS that could put you under the taxation structure of an S corporation. So really, for me, I want to see clients do this when they have enough income to justify the tax savings against this additional cost. So I usually tell clients, once you're at about 60 to 70K in gross income, this becomes a great opportunity for you when we should sit down and crunch the numbers.
Got it. So, and does that also kind of follow, if somebody's starting out and they've got a W-2 job and clearly it's not their full-time occupation, not an active investor, but a
real estate professional.
Yeah, real estate professional. But you're saying that as far as a kind of a measure of when it makes sense to go from an LLC to an S corp is when you're at least generating 60,000 plus income, gross income then you can make sense out of being an S corp. Is that kind of what I'm hearing?
Absolutely. And, anytime that you are making this decision and you're sitting down with a CPA or any other type of professional, they should be able to clearly explain to you what the tax benefits are going to be and what the costs are going to be of moving into this structure. And the way that I do that with clients is by taking a look at their prior year tax return and then making projections on their income for the current year. And based off of that, I'm able to determine with a fairly accurate estimate what their tax savings will be, and obviously I'm able to quote them up front on the additional cost to administer the corporation.
Got it. All right, so the entity selection, we start out, maybe we're an LLC, we've got the pass-through, which essentially the income is going to be treated like at an individual level. Is that accurate?
Yeah, so whenever you're in a single member LLC, which means there's one member in the LLC, or it could also be a married couple that's filing their tax return jointly would also be treated as a disregarded entity, which is a single member LLC. That all is filed on your personal tax return, and that's why your compliance costs are minimized greatly. Now, when you move into an S corporation, you're filing a completely separate tax return, and then a K-1 is attached behind your personal tax return to represent your share of income from that corporation.
All right. Let me ask you this. So the entity that you own the real estate, and let's say you're in a buy and hold plan, and you've got some real estate, a couple pieces of property, and they're generating income. Is there any restrictions on keeping the income in that entity, or does it all have to be paid out to the members? Is there any kind of
Well, this is when we get into the reasonable compensation study. So each year that you're an S corporation, you're gonna, by working through a reasonable compensation study, which looks at various points of market data that the IRS has used in past court cases to determine what a reasonable compensation is for a taxpayer. We work with clients through that process, and we determine what a wage is for them. Whatever's left over after the S corporation incurs all of its expenses and all of its wages is passed through to the shareholders as a distribution on the K-1. So all the income year over year is passed through and taxed at a personal level because it still is a pass-through company. But what it allows you to do is the distributions that you're passing through aren't exposed to the self-employment tax. It'll only be exposed to your income taxation.
Got it. And for the LLC, is that the same pass-through on that, or?
It's the same pass-through, but the only other issue is that if it's an active business, you're going to pay an additional tax and self-employment tax.
Got it. But if you're passive, then it would be just
income.
Is it ordinary income then, or is it distribution like a?
It would be ordinary income at your rate.
Gotcha. Okay. Can you touch on the difference between ordinary and what's the alternative? If it's not ordinary income, is it a distribution? Or is that?
Well, you're always going to pay ordinary income. You're always going to pay ordinary income.
Okay. Income tax.
The only difference is when you're an S. Yes, it's the income tax. So, your distribution and your wages are both going to get hit with ordinary income.
Okay.
But only you get tax self-employment tax. And that's the reason why, you would ideally like to set your wage as low as possible to minimize tax scrutiny with the IRS. So that's why we go through the exercise of determining a reasonable compensation and substantiating it in a report to, one, have an accurate estimate so we're not leaving money on the table and exposing ourselves to risk, and then two, also to substantiate our position in future years if this ever did come under scrutiny with the IRS.
All right. And then above and beyond the ordinary income, above and beyond your reasonable compensation, anything that gets paid to you, is that a dividend then, or are you able to classify that differently, or is there a...
Well, it'll come through as a K-1 as rental income. It's passed through with the same character of income as the corporation made, since it's a pass-through entity, and it's just passed through to each partner on their K-1 based on their distributive share. So, if it's one person in the S corporation, all the income would get passed through to them with the same income characterization. Okay. The only real difference is the self-employment tax. Okay,
and just for some sort of an understanding, what kind of a rate is a personal income or a self-employment tax?
Yeah, so the ordinary rate's determined by your income. Self-employment tax is 7.5%.
Okay, so 7.5% is kind of the threshold of savings.
Yes.
Gotcha.
And you're able to recharacterize a large portion of your income.
Okay, and save that additional 7.5%. That's great. So what I think I heard you say was that somebody that's doing both the buy and hold strategy and then also has the fix and flip operation going on, you're suggesting that they maintain two separate entities, two separate banking accounts. Did I hear you right?
Yeah, so you want to establish two separate entities, and then you want to maintain what's referred to as corporate veil in those entities. And that just basically means keeping your income and expenses separate, just keeping them as two distinct entities. So that way your active income can get passed through at its tax rates, and the passive income can get passed through at its tax rates as well.
Got it. On active versus passive, in just general speak, is the passive income, is it treated more preferential, or is active, as far as the tax rate, just active versus passive?
The big preference really is just not being exposed to the self-employment tax.
Okay.
The only other preferential treatment would be upon a sale if you're looking at the difference in capital gain rates.
Okay, and which is more advantageous? Is it the passive?
Well, it's always advantageous. Oh, well, in terms of capital gain, it just matters if you're a short term or long term. If you hold a property for less than a year, you're not going to have as good of a tax rate as if you held the property for more than a year.
Okay, and is there a percentage difference that you can speak to, or is it?
Yeah. So the long-term rate is 15%. The short-term rate, I want to say, is 25%. I would have to check that, but it is a fairly large difference.
Okay. Well, I think that's the just as kind of a gauge on recognizing if you're flipping, you're going to be in and out and paying more of a higher rate. Based on you're not holding the property long enough. If you're holding for a year and a day, you're able to back your tax rate down. Is that kind of the sum of it?
Absolutely. Yeah, there's always more tax advantages in terms of the treatment of your income from being a long-term investor.
Got it. All right. So I've walked into your office. We've talked about what my strategy is going to be, how I'm going to operate my real estate investment business. We've made a selection as to entity, S Corp or LLC. You've talked to me about maintaining separate entities and separate accounts if I'm going to be doing multiple activities. And then also the kind of the distinction. If I'm, at what point does it make more sense to be an LLC versus an S corp? We talked about an income threshold there. Or where do people get tripped up? Or what are some of the things that you've seen that people, maybe some mistakes that they've made in operating that have been costly that they could have avoided?
Definitely. Well, first and foremost, I think I did previously mention this briefly, but the S corporation structure. If you go online and start Googling this, you're going to see a lot of hype about the tax benefits, and that's because they are very substantial. But like I said, they don't come without costs, and those are usually much less aware. People are much less aware about the cost than the tax benefits. So, for a structure you choose, the cost of administering it isn't going to outweigh the tax benefits of being in it. Secondly, any entity structure that you do go into, especially when you get into S corporation structures and there's tax implications to being in this business structure, not commingling funds is imperative. And, that's a fancy word, but all it means basically is maintaining separate business accounts for your companies and only having company income and expenses go through those accounts. Those really are some of the two of the biggest issues that I see people run into with structuring themselves initially. The only other thing, obviously, is you never want to put passive activity into an S corporation, because that just doesn't make sense. Because then when you're in an S corporation, you're forced to pay yourself a wage, so you're going to end up exposing a portion of your income to self-employment tax rather than shielding a portion of it. Got it.
Well, that's I think the S corp versus the LLC is something that I guess I've not fully understood up till now. But as I understand more and more, is the basis of your operations are really where it kind of, well, obviously it merits making the decision. Let me ask you this. So a lot of times, like two partners come together to buy a property, right? And oftentimes, and again, as an insurance broker, I see this all the time, the property is held in an LLC. Can you speak at all to that, or is there any reason, or can the S corp create an LLC for a specific property if you've got multiple properties that with different different investors? Can you speak to that a little bit?
Yeah. Well, what I would say to that point, when you are taking on partners, basically, all the criteria that we outlined up to this point still holds true in terms of the passive versus active activity. The only difference is that if it is a passive activity and you're taking in an outside partner you're not filing a joint tax return with, you are going to have to file a partnership tax return. You're still going to get pass-through treatment. You're still not going to have to pay yourself a wage, but there will be an additional compliance cost associated with that. If it is still an active business and you do meet the income thresholds to where the tax benefits outweigh the cost, you still want to go with an S corporation structure. The only other thing that I would mention is that S corporations are LLCs. And so, like if I was going to set up an S corporation for somebody, I would start by filing an LLC with the Secretary of State. Once the articles of incorporation were approved by the Secretary of State, then I would get an EIN from the IRS, and we would set up your bank accounts and everything like that. And next, we would file a few additional forms with the IRS. One specifically is Form 2553, and we would elect to have the LLC to be treated as an S corporation. And that's one why, as I previously mentioned, you can have the flexibility throughout the year and when you make that election, and you can use that as a tool to determine whether or not it makes sense to assume this structure. And Yeah, so, an LLC is an S corporation if you elect to be treated as such. And that's a distinction sometimes that I see clients not clear about as well.
Yeah, I'm going to have to ask you again on that because so an LLC or an S corp is an LLC. Is that what I just understood you?
Yes, because an S corporation is a taxation structure with the IRS. So you elect to be taxed as an S corporation with the IRS. And now you file your company with the Secretary of State. So there's a distinction between the two.
Okay. So I set up you set up my entity, and even if I'm going to be an S corp, it's an LLC with the distinction to be an S corp. Is that right?
Yes, it's an LLC, and then we make an election to be taxed as an S corporation.
Gotcha.
It's more of a technical point than anything that's going to affect the operations of a real estate investor. But the reason that I do make this, especially in terms of making that retroactive election for someone getting started out, you can get into the LLC structure and you can touch base with a CPA like me, say in October or November, and we could take a look at where your income is at. And then if it is necessary and it does make sense, we can make that retroactive S corporation election and you can be treated as such.
Got it. So it sounds like it's an active conversation with your CPA as you're starting out. Is that fair to say that you need to stay engaged and make sure you're on the right path?
Yeah, like most tax issues, they're only going to affect you once a year. But if you want to be in the correct position in terms of, your finances and what you've been doing throughout the year, you really have to have a close relationship with your CPA and be proactive about reaching out to them.
Got it. Well, Patrick, the entity selection issue, I think it's clearly it's an important one, and I think that if somebody's not aware of, I'm wondering if you could talk just a little bit as to let's say somebody's already been doing business, they've been acting as an individual, and they've generated some income. Can you speak just real briefly to the consequence or the lack of benefit of acting as an individual as opposed to being an LLC or an S corp?
And being an individual and an LLC doesn't have any tax implications. It's more from a liability perspective. If you do set up a limited liability company that's separate from your person and you maintain what we refer to as the corporate veil, it will help you in court, especially if you establish an operating agreement as well. It's going to set up a distinct entity from you. So if you do have issues with a product, you'll only be able to come after your company's assets as opposed to your personal assets. When you get into tax implications more, it really comes back to the S corporation and the minimization of the amount of income that's exposed to self-employment taxes. So, anyone that's starting to get 60, 70K and they're filing as an LLC and they're not recharacterizing their income, they're leaving a substantial amount of money on the table with the IRS.
Got it. Well, Patrick, let me ask you this. What's the first step?
The first step is always first determining and being completely clear on what your investment strategy is. And then once you're clear on that, consulting with a CPA, like myself or like any other professional that's focused on the real estate industry and can guide you throughout this decision-making process, because like we just illustrated here, it can have very large tax consequences. Once you're clear on your entity structure, from there, you'll begin the process of establishing your entities and your bank accounts accordingly.
Got it. Patrick, is there anything that we didn't touch on here that you wanted us to discuss as far as the entity selection?
No, those were the really three main points that I wanted to hit on, was to be careful from commingling funds and also the difference of the taxation structures between the two companies.
Got it. Before we wrap up here, wanted to remind, or at least ask you, are you limited geographically where you can work with people as far as your CPA practice?
Absolutely not. We work with obviously a heavy concentration of clients in the Carolinas. I'm originally from the Northeast, so we have a large concentration of clients in the tri-state area, New York, New Jersey, and Pennsylvania. We also have a high concentration of clients in California, Texas, as well as a few other states. So we're located in Charlotte, North Carolina, but currently we're working with clients in about 12 or 13 different states, and we make the virtual working process completely seamless.
Got it. And what's the best way for somebody to get in touch with you if they wanted to reach out to you for some entity selection or tax help?
Absolutely. The best way to get in touch with me would be visiting my website. That's CamusoCPA.com, CAM as in Michael, USO, CPA.com. And if you visit the Contact Us page, you'll find all of my contact information there. We pride ourselves on being very responsive to both clients and potential clients. So anybody that does reach out to us, we get back to them usually within the same day or the next day at the very latest. Got it.
Patrick, I want to thank you again for taking time today to talk, and enjoyed it. I think it's a huge topic, and for people that haven't gone through the exercise or understood their liability or the tax complications, it's something they need to get a handle on. So I appreciate you taking the time to do this. And as far as that goes, I want to say look forward to doing it again if you're available. I'm sure there's plenty of other topics we can talk about regarding taxes and real estate investing.
Absolutely. Yeah, no, I definitely look forward to being back on, and I think there's a lot more topics that we can discuss about as we start to progress with this fact pattern, and you have clients that are doing buy and holds or in an S corporation, we could discover more tax planning opportunities.
All right. Well, for our listeners, if you like the show, we ask that you share the show. It's real easy to do. You can hit the share button and share this with somebody you know that would find Patrick's information about entity selection useful. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.